Hello everyone, this is Dr. Kenneth Tarr. Today we are going to consider Chapter 6, which is risk and return. Companies are usually concerned with risk and return. They'll always want to minimize risk and maximize return. In this chapter, we are going to talk about the basic return and risk concepts. We'll look at standalone risk, which is the risk of a single asset, a single company. And then we'll look at the risk that is associated to a portfolio, which is a group of securities. So you can get into the market by holding a single company. In that case, you want to understand your return and your risk. And then you can start buying many other companies. So a group of companies in your portfolio makes what we call a portfolio. A group of companies make what we call a portfolio. So you are interested in understanding how you can calculate the return and the risk of your portfolio. Then we'll bring risk and return together in a model that we call the capital asset pricing model, which is CAPM. Another name for CAPM is the security and market line, the SML. Then we'll talk about different forms of market inefficiencies. All right, determinants of intrinsic value. We calculate intrinsic value by calculating the present value of each cash flows, and then we add them up. So the present value of cash flow 1 plus present value of cash flow 2, cash flow 3, and so on and so forth. And we use the WACC, which is the weighted average cost of capital, in calculating the present value. So what are investment returns? Investment returns measure the financial result of an investment. The financial result of an investment. Returns may be historical, or it may be prospective, or what we call anticipated returns. It can be expressed in dollar terms or in percentage terms. We see this example: an investment costs 1,000 and is sold after a year for 1,060. So what is the return? In dollar terms, the return is 60%, which is the 1,060 minus 1,000. So it is the dollar received minus the dollar invested, which gives us $60. Percentage return is actually the dollar return divided by the dollar invested. So the amount that was invested is 1,000. What is returned is 60, which is 1,600 minus 1,060 minus 1,000. So divided by 1,000, that gives us a percentage return of 6%. So this is how we can express return. In dollar terms, the return here is $60, and in percentage term, the return is 6%. What is investment risk? Investment risk is exposure to the chance of earning less than expected. So there is always an expected return. If we make less than expected, that is what we call investment risk. This is what we call a scenario analysis. And from this scenario analysis, we can calculate the return or the average return. And we can also calculate the risk that is associated with this scenario. So with the scenario analysis, we have different scenarios that are given. We have worse poor, most likely, good case, best. And different returns are attached to the different scenario. Worst case, -14, best case, 26%. Different probability. Worst case, we expect a -14% return. The probability of that happening is 10%. Good case, we expect a 16% return. The probability of that happening is 20%. So this is what we call a scenario. So it could be the financial manager thinking about future return, and they are making an estimate, a prediction, an anticipated return. So it depends on different scenario. So in the worst case, it will be a -14% return. The probability of that happening is attached to this -14%, which is 10%. So from this scenario, we can actually plot what we call a discrete probability distribution, where we have on the y-axis the different probabilities, and on the x-axis the different returns. So if we look at this probability of 10%, attached to it is -14%. So the discrete probability distribution will look like this. Again, the y-axis, we have probabilities. The x-axis, we have return. The -14 is attached to the 10%, and so on and so forth. So this is discrete probability because the data can only take a certain value. So we can only have -14, and 10%, we can have -4, and attached to that -4 is 20%, and so on and so forth. When we connect this point, something like this, it is going to change from discrete probability distribution for a scenario to a continuous probability distribution. And it's going to look like this. So this is an example of a continuous probability distribution. It is continuous because the data can take any value within a specified period, can take any value, unlike discrete, where the data can only take a certain value. With continuous probability distribution, the data can take any value within a specified range. So the data can take this value, it can take this value, it can take this value, any value within the specified range. All right, so now we want to see how we can calculate the return and risk of a scenario. So calculate the expected return on a bond for the next year. So we have this bond. In calculating the return, we basically take each probability times return, and then we sum them up. So this is the formula where we are taking each probability times return, and we sum them up. That is going to give us the average return, or the expected rate of return of this scenario. So if we come here, so what we are saying is that we basically take 10 times -14 plus 20 times -4 plus 0.4 times 6%, and so forth, and so on and so forth. So when we do that, we end up with an expected return of 6%. So it is probability times return plus probability times return plus probability times return plus probability times return plus probability times return, according to the formula. So that will give us the expected return. We can do this also using Excel, where we just take, we go to Excel, we take equal, the sum product, and then we drag in the probabilities and return and take enter, and that is going to generate the correct answer for us. So we can consider this probability distributions for two investments. The question is which is riskier and why? So we can call this one distribution 1, and we call the other one distribution 2. So if we look at this distribution, in the middle here, we are going to have expected return. So my argument is that it is this distribution 2 that is riskier. Question is which one is riskier and why? So this one is riskier. The reason is because we can see that it has large deviation from expected return. It has large deviation from expected return. So this is the expected return. Unlike this first one, the expected return can either be at this point or this other point. But this has a much larger deviation from the expected return, which is a measure of risk. The larger the deviation is from the expected return, the larger the risk. So standalone risk, we measure risk by simply calculating the standard deviation. So the standalone risk is the risk of each asset held by itself. So that asset is there by itself. So the standard deviation measures the dispersion of possible outcomes. And as we have said, we basically calculate the standard deviation. So this is the formula for calculating the standard deviation. This first one is the variance, and then the square root of the variance gives us the standard deviation. So the standard deviation or the risk. So we take each probability, multiply it by each return minus the expected return. So this is the expected return that calculated before. Expected return that we calculated before. So we take each return minus the expected return squared times the probability, and then we sum them up and take the square root. So this is what we call the variance, and then this one down here is the risk measured by the standard deviation. So this is how we calculate it. Again, every probability times return minus the expected return all squared plus probability times return minus the expected return all squared plus probability times return minus the expected return all squared. Once we do that, we end up with 0.012, which is the variance. We take the square root. Our final answer becomes 10%, which is the standard deviation. It becomes 10.95%, which is the standard deviation. So that's how we calculate the return and risk of a single asset. And also we can use formulas in calculating that using the sum period. All right. So what are the useful information that is associated with comparing investment? The bigger the standard deviation, the more risk that is associated with that particular asset. So large standard deviation just suggests to us that there is a large risk. This does not mean that we need to reject the investment. All it's telling us is that we should know about the risk before investing, and that we should expect a higher return as compensation for bearing that risk. So now we want to see how we can use historic data in calculating the risk and return. We have seen how we calculate risk and return for a scenario analysis. So in that case, we are using anticipated data. It's important for us to note that most analysts use historic data rather than discrete forecasts to estimate investment risks. So since it is the use of historic data, if the data is monthly, they'll mostly use between 48 to 60 months data. If it is weekly data, they'll use about 52 weeks. If it is daily data, they are going to use even a much shorter period. So this is the formula for calculating the average return and the risk using historic data. So the average return is basically sum of all the returns divided by the number of return, which is T. And then in calculating the risk, we calculate the standard deviation and then we take the square root. So it is basically each return minus the average return that was calculated above, all of this squared, and then we sum them up and we divide it by T minus 1. So if we have data for 15 years, T is 15. If we have data for 10 years, T is going to be 10. All right, we can also just use average and standard deviation in Excel, where we take enter average, and then we drag in the sample data. That will just easily calculate the average return for us. If it is the standard deviation, we can say enter ST DEF, and then we drag in the sample data and it will calculate for us the estimated standard deviation. All right, so this is an example of historic data for 10 years for market and 2 other companies. So our task here is going to be to calculate the expected return and to calculate the risk. So the expected return, if we look in terms of the market, it's basically to add up all the returns and divide by 10. Brand is same, we add all the returns and divide by 10. And then for us to calculate the standard deviation, we take each return minus the average return squared, we sum them up and we divide by T minus 1. Again, this can easily be done in Excel when we have large data like this. So if we follow the procedures, we realize that we end up with this average return for the market, Blandy, Gomage, we have average return and risk that is calculated. So looking at what has been done above, we can ask ourselves, how risky is Blandy's stock? So the assumption is that the returns are normally distributed. If that is the case, we see that the standard deviation of the risk that is associated with Brandy is 25.2. The expected return is about 6.4%. So in general, stocks are risky. We find that the stocks are high. Brandy has a higher standard deviation, and Gomash also have quite a high standard deviation. So for both companies, their standard deviation is higher than that of the market. All right, so we are now go to portfolio return. We have seen how to calculate the return and risk of a single asset. Now we want to calculate the return and risk of a portfolio. So with a portfolio, it is basically a group of stocks. So it's more than one, it's a group of stocks. So with n stocks in the portfolio, the return is the weight times the return of those individual assets that make up the portfolio. So the return on a portfolio is sum of weights times the return of each asset in the portfolio. So that means that we can, instead of having Blandy and Gomash stock separately, we can build a portfolio. So we can ask ourselves that what can be the weight of Blandy and then the weight of Gomash. So the weight of Blandy is 25%. So from our total budget, we invest 25% in Blandy. So 1 minus 0.25, it implies that 0.75 will be the investment in the other company. So the return on the portfolio becomes 0.75 times the return of Blandy plus the weight of Go, which is 0.25 times the return. So that is how we are going to calculate the expected return. And again, once we do that year after year, we are going to have a different return. So here we said this is 25%, which automatically means this is going to be 75%. So for this first year, the return of the portfolio is sum weight times the return of each individual asset. So in this case, it is going to be 0.25 times 26% plus 0.75 times 47%. And that is how we end with 31.3%. And we do that year after year, we have different returns. And those are portfolio returns. So we have different portfolio returns. So we can add them up and we divide by 10. We take 31.3 plus negative 2.3 plus negative 6.8 and so on and so forth. We'll end up with a portfolio risk of 22.2 and a portfolio average return of 7.1. 7.1. So what do we find? We find that the portfolio standard deviation is less than that of any of the stocks. So the standard deviation is 22.2. If we go back and look at the standard deviation when we calculated this individually, so 25% and 38. So very high risk for the two companies. But when we combine them and bring them in our portfolio, what we find is that the portfolio standard deviation is less than either of the stock standard deviation. So the more we bring assets into our portfolio, we depress the risk, we eliminate the risk, we reduce the amount of risk. We can track the movement of the two companies, Gore and Blandy, and we notice that the return don't move in perfect locksteps. Sometimes one is up and the other one is down. So this brings us to the concept of correlation coefficient. What is the correlation between these two companies? How are the returns moving year after year? So the correlation coefficient, loosely speaking, measures the tendency of two variables to move together. So the correlation coefficient, we say rho, and let's say for variable I and variable J is equivalent to this. So this is how we calculate the correlation coefficient using historic data. So we are taking every return of every return of an asset that makes up the portfolio minus the average return. So since there are two assets in this portfolio, I and J, so is the return of company I minus the return of the portfolio times the return of company J minus the return of the portfolio divided by, we take the sum divided by all of this. That will give us what we call the correlation coefficient. So an easy way to calculate the correlation coefficient is through the use of Excel, where we basically hit equal, correl, and then we take in stock I and stock J. Once we take all of that and hit enter, it is going to generate for us a correlation coefficient of 0.12. Correlation coefficient runs from -1 to +1, from -1 to +1. If the correlation coefficient is equivalent to -1, it implies that the two stocks can be combined to form a riskless portfolio, So in that case, the portfolio standard deviation or risk is going to be equivalent to 0. If the correlation coefficient between the stocks is +1, the risk is not reduced. The risk is just the weighted average of the two stock standard deviation. So the range -1 to 1, not reaching at -1 or 1 correlation coefficient will simply imply that risk may be reduced but not eliminated, as the case above, for which the correlation coefficient between the two assets is equivalent to -1. So we build a portfolio by adding stocks into our portfolio. The risk is going to decrease when we add stocks that are not perfectly correlated. So if we can find two stocks that are perfectly negatively correlated, then the risk of holding those two stocks in the portfolio will be 0. So we want stocks in our portfolio that are negatively correlated so that that can reduce the risk that is associated with that portfolio. So talking about risks, there are different types of risks. We can say we have what we call the market risk. We have what we call the company specific, or diversifiable risk. And then we have the total risk. So the total risk is a combination of the market risk and the company-specific risk. The company-specific risk is the risk that is associated with that company. This kind of risk cannot be diversified away. Sorry, what cannot be diversified away is the market risk. The company-specific risk is a risk that is attached to a particular company. We also call it firm-specific risk or diversifiable risk. So this is the risk that can be diversified away. It can be reduced or eliminated by increasing assets into our portfolio, especially assets that are negatively correlated with each other. We have market risks or systematic risk. This kind of risk cannot be eliminated from the market. It cannot be eliminated through diversification. So that means total risk is equivalent to a company-specific or diversifiable risk and market risk, or what we call systematic risk. So as far as standalone companies are concerned, the risk is both market risk plus diversifiable risk, Okay. So by forming a well-diversified portfolio, investors tend to eliminate about half or a certain proportion of risks of owning a single stock. So it reduces risk. Diversification tends to reduce risk. So rational investors will minimize risk by holding a portfolio, which means that investors tend to bear only market risk. There's a strong assumption that investors hold a portfolio which eliminate firm-specific risks. Therefore, investors tend to bear only market risks. They tend to bear market risks. All right. So we are going to go into the concept of capital asset pricing model, market risk due to an individual stock. How do we measure the amount of market risk that an individual stock brings to a well-diversified portfolio? William Chap developed the capital asset pricing model to answer this kind of question. So market risks as defined by CAPM, we have WI, which is the percent of the portfolio invested in stock I. And then we have the standard deviation of the market, or the risks of the market, which is the standard deviation of the market index. And then we have the correlation coefficient between stock I and the market. So the contribution of stock I to the standard deviation of a well-diversified portfolio is basically the weight of stock I times the risk of the market times the correlation coefficient between the stock and the market times the standard deviation of the stock divided by the standard deviation of the market. So the beta of stock I is also defined, which will make it possible for us to refine the above formula a little bit. So the beta coefficient, the stock beta coefficient, BI, is the correlation coefficient between the company and the market times the standard deviation of the company divided by the standard deviation of the market. So the contribution of stock I, therefore, to the standard deviation of a diversified portfolio is basically the weight of stock I times the standard deviation of the market times the beta coefficient of stock I. And this is true because if we look at this formula, now we are told that the beta is correlation coefficient between stock I and the market times the risk of the company divided by the risk of the market. So if we take, if we try to substitute that, this will be all of that. So this implies that we will end up with something like WIQM, which is the standard deviation of the market. All of that is the beta I, the beta I. So this is what we have. So beta measures the impact of I on Q. So the standard deviation of the market and the percentage of portfolio invested in stock I, and the beta measure the impact of stock I on the portfolio and the portfolio risk. All right, the beta coefficient, we can talk a little bit more about this. So stock I contribute more risk if two things happen. Number one, if the correlation coefficient, so this is going to be high if this is high and if this is high. So the stock contributes more to the risk if the correlation with the market is larger. So if this is larger, or if the standalone risk is larger, or if this is large. All right, the required return and risk. Investors require return for time if they are to invest in the company. They need a minimal payment plus a premium for the risk they are taking. The return for time is what we call the risk-free rate. And when investors require a return for the risk, the market risk they are taking, that is the risk premium, stock I. So the market risk premium is basically the market return minus the risk-free rate. So the company's risk premium, therefore, the company's risk premium is equivalent to the company's beta coefficient times the market risk premium. So this is the formula for the capital asset pricing model, which is also the security market line. So the security market line SML puts the pieces together. It shows how to determine the required return for bearing the stock's risk. So this is how required return is going to be computed. So we will call this the SML line O. It is CAPM, Capital Asset Pricing Model. All right, if we look at Blandy's company, we can calculate the beta coefficient for Blandy. Basically, we are going to take the correlation coefficient between Blandy and the market, and we multiply that by the risk of Blandy divided by the risk or the standard deviation of the market. So this is the formula. Okay. So in that case, it is going to give us 0.6. So the beta coefficient is 0.6. All companies tend to have their beta coefficient. And if the beta coefficient is equal to 1, or the average beta coefficient is equivalent to 1. So Blandy tends to contribute less risk to a well-diversified portfolio than an average stock, because it's very close to an average stock. So it's 0.6. An average stock is going to have a beta coefficient of 1. All right, the beta coefficient measures how the company's return is going to react with respect to the market return. And every company tends to have their beta coefficient. Once we have the beta coefficient, it is easy for us to calculate the required return of that company. And that is really what we call, we can use capital asset pricing model. So this is the formula for CAPM, capital asset pricing model. We have the required return, which is the risk-free rate plus the beta coefficient times the risk premium, or we can say this is the market return minus the risk-free rate. So this is given if the risk-free rate is 4% and the risk premium is 5%, the beta coefficient is estimated to be 0.6. What is the required rate of return for this company? So once we put in all of this information, the required rate of return for the company is going to be 7%. It's going to be 7%. So this is really capital asset pricing model. This is how we calculate CAPM. So just as I said, we can have all of this, or we can say this is the risk premium of the market. Okay, couple of things. This CAPM tell us how we calculate the required return of a company. This is what investors are demanding for them to invest in a company, the return they are expecting to get. They will first want a return that is at least the risk-free rate plus an additional amount because they are taking market risk. So it will be beta of that company times the risk premium of the company. The beta coefficient It's actually the slope of the company's return and the market return. So the company's return and the market return. So this slope is what we call the beta coefficient. So BI. So the beta coefficient of blending. So once we have the beta coefficient with the risk-free rate and the market risk premium, we can calculate the required return. So we can do that for all the other companies, and we can have their respective required return. Companies' beta coefficient, we can find them on various websites online. All right, one of the last things we want to talk about is the security market line and what is driving the security market line. So if we look at this diagram, this is really capital asset pricing model that has been placed in a diagram. When we place this in the diagram, this becomes the security market line. So it is a relationship between the beta coefficient and the required return. And we start with the risk-free rate here, risk-free rate, which is RF, the risk-free rate, which is somewhere on this y-axis. A risk-free rate. A risk-free rate will be the rate of the government bond or government security. It doesn't have any risk. So the beta coefficient is 0. And then as the beta coefficient goes up, the required return seems to go up as well. So once we build that, we end up with this line. So this is what we call the security market line. Okay. So we can ask ourselves, what is going to move the security market line? So there are two things, is when investors become more risk adverse. So notice, if we look at this first case, this is a beta coefficient of 1. So this is the market beta. So we'll come somewhere here. This is going to be RM, which is the market return, So this difference, it is actually what we call the risk premium. So it's a risk premium. So risk premium for the market, which is M minus RF. All right. So now that is the amount that investors would like as compensation for investing in the market. So if investors' risk aversion increases, they'll want more compensation. So that is what is going to move the security market line. So the risk-free rate remains the same, except now we have a new RPM, which is risk premium, which now becomes, which is RM minus RF. So the security market line is going to, can stay at the risk-free rate and then slant upward. So this is the case for which investors become more risk-averse. So we are looking at the impact on the security market line. The impact on the security market line of increase in the risk-free rate. So the first scenario is that investors become more risk adverse and the security market line is going to move upward. This is another scenario. In this case, this is when there is inflationary expectation. So in this case, the risk-free rate is going to increase. So we have something like this. This is the risk-free rate. The risk-free rate is made up of this nominal rate plus a certain inflation premium, which is compensation for inflation. So if there is an expectation that inflation is going to go up, inflationary premium is going to go up. So the new inflationary premium goes up. So this is new inflationary premium. New inflationary premium, which means that the risk-free rate goes up. So the impact of security market line in risk-free rate, So the risk-free rate increases, the security market line is going to jump up. So this is the risk-free rate. This becomes the new risk-free rate. All right. So we have two impacts that can occur as far as the security market line is concerned. We can have a change in the risk-free rate, which is usually driven by a soar in inflation. So there is inflationary expectation, or we can have risk aversion. So here we have risk aversion. So investors become more risk adverse and they are demanding a higher risk premium. As a result of that, even though the risk-free rate remains the same, the security market line is going to tilt upward. All right, I believe that is it for this chapter.